Good morning, everyone, and thank you for joining us today. My name is Richard Barnwell, and I'm a partner within BDO's FS advisory practice. My focus is on governance, risk, and conduct across the FS sector. So as you can imagine, it's been a fairly busy 6 weeks or so for us. The first thing I wanted to say is that from all at BDO, we hope you and your respective teams, families, and loved ones are safe and well during this difficult time. Over the past few weeks, we've been supporting our clients respond to the crisis, and through this, together with our ongoing conversations with the FCA, PRA and trade bodies, we've gained insight that we are very keen to share. From a financial perspective, the insurance industry is generally well prepared for major loss events like COVID-19, albeit the true financial impact will likely take some time to fully play out. More broadly, what we're seeing is that insurers are having to consider and respond to COVID-19 on multiple fronts as claims payers, employers, and also investment managers. The financial impact of COVID-19 will be specific to each business and obviously will vary according to classes and mix of business underwritten, pricing and reserving, policy wording, and reinsurance coverages. From a customer/consumer perspective, the FCA has published a statement on what it expects insurers and brokers to be doing during the pandemic. Firms should consider the needs of their customers and show flexibility in how they are being treated during this time, particularly as policyholders will have to change their behaviour during the pandemic. Firms must have plans in place to mitigate the operational impact of the virus. Senior managers should be given responsibility for business continuity and managing the impact of coronavirus. The FCA has in particular raised concerns about the treatment of policyholders at renewal, mid-term adjustments, and product suspensions. In light of what we're seeing and hearing across the sector, we thought it would be useful to focus on three key things today. Senior manager responsibilities, reasonable steps, and the following of SMS, operational resilience, and then spend some time on the specific impacts of COVID-19 on the insurance sector, where we will touch on underwriting and claims handling, balance sheets, and the regulators' focus on solvency and conduct risk. My colleague Charles Portsmouth, who will properly introduce himself later, is going to cover the third of those agenda items. Now, I know some of you have attended our previous webinars, and therefore you probably will have heard already some of the content that I'm going to cover in items 1 and 2, but hopefully this will serve as a useful reminder. And there are 1 or 2 things that have changed over the last few weeks, so the content has been updated. Before I do get on to the content, there's just a few housekeeping points that I wanted to touch on. Today's webinar is going to be recorded and we'll circulate the slides later on. Your lines will all automatically be muted throughout the webinar. So if you do have questions, please use the panel throughout the session using the Q&A box on the bottom right hand of the screen that you can see. And when you do send questions, please ensure that you address these to all panelists in the drop-down box. If you're having any problems at all during the presentation in terms of seeing the slides or being able to hear us, then just put a comment in the Q&A box and we can obviously try and address it. Okay, so moving on to governance. The speed and breadth of the unfolding COVID-19 crisis is putting nearly every facet of business to the test. So clearly responding to the humanitarian crisis is priority number 1. However, there are also significant implications for board members who need to be decisive in protecting their people and organisations throughout this current phase of the crisis to the next one, and ultimately the longer term. The buck stops with the board. We all know that an effective board defines a company's purpose and then sets a strategy to deliver it. This purpose is still relevant in the time of a crisis. While management teams run companies on a day-to-day basis, boards are ultimately responsible even in the times of crisis. So, the starting points for boards in this crisis, just as in any other crisis, is to direct the company in a way that is effective for all key stakeholders. Transparency and effective communication become even more important during the time of crisis, and board members need to ensure that they all have access to relevant information. Being clear on who is calling the shots is important. Ultimate accountability is likely to sit with the CEO, but there will be other members of the management team who hold senior management functions who are also likely to have key accountabilities. The FCA has stated that they do not require firms to have a single senior manager responsible for their coronavirus response. However, firms should allocate these responsibilities in a way which best enables them to manage the risks they face. And there are, of course, existing responsibilities specified in the senior managers regime, for example, SMF 24 for operational resilience and SMF 2 for financial resilience, which are clearly relevant. Of course, there may be scenarios where firms need to make temporary arrangements to cover absences or change senior management responsibilities in direct response to the pandemic. The regulators have indicated that they want to take a pragmatic approach to SMCR compliance during this unprecedented time, minimising the burden for firms and relaxing some of the SMCR requirements. However, it is important that this is not confused with a relaxation of the principle of individual accountability and robust governance arrangements. Many firms have inquired whether the SMF 24 Chief Operations should take responsibility for the firm's response to coronavirus. While compliance with regulatory requirements in relation to business continuity, information security, and outsourcing would naturally fit with the SMF 24 function, several aspects of firms' responses to coronavirus, e.g. managing liquidity, may naturally sit with other SMF holders. The statements released by the regulators clearly outline that firms are not required to have a single manager for their COVID-19 response. Clearly, it would be incredibly challenging for a senior manager to take full responsibility and accountability for an organisation's COVID-19 response on their own. However, the regulator does recognise that the current circumstances may mean changes to the responsibilities of many SMF holders. So for dual regulated firms, they may well need to revise and update and resubmit statements of responsibilities for its senior managers where this is the case. While there is no fixed statutory deadlines for firms to resubmit SORs at this stage, and we understand this is something that the regulator is reviewing, we encourage firms to review whether responsibilities for SMS holders have changed in the light of the crisis and then resubmit impacted statements of responsibilities as soon as practical. From our perspective, this tends to work best with boards engaged and leading the process with input from HR and compliance as necessary. For solo regulated firms, the FCA does not expect firms to resubmit statements of responsibilities for its senior managers if the change is made to cover multiple sicknesses or if changes in responsibilities are in direct response to the pandemic and are temporary and will not change permanently. It is worth noting here, though, that there is an expectation that any such changes should be documented and updated internally. So just moving on to the 12-week rule and temporary arrangements. Of course, it is expected that there will be scenarios where firms need to make temporary arrangements to cover absences, perhaps due to sicknesses or for furloughed staff. Many of you will be aware of the 12-week rule, which allows an individual to cover for the senior manager without being approved where the absence is temporary or for reasonably unforeseen. The regulator understands the concerns that many firms have in respect of compliance with the SMCR requirements, including the 12-week rule, and does intend to offer flexibility where possible. So for dual regulated firms, the PRA and FCA are currently gathering evidence on whether the 12-week rule is likely to give dual regulated firms enough flexibility to deal with the temporary absences that may be occurring because of COVID-19. If the FCA and PRA conclude that the 12-week rule is insufficient to allow firms to respond to temporary absences linked to coronavirus, they will consider additional measures. firms should still allocate to the most senior person responsible for that activity or area who has sufficient authority and appropriate level of knowledge and competence to carry out the responsibility properly. The covering manager will require access to the governance forums they need to exercise their responsibilities, and changes of this nature should be recorded in other documents, such as responsibilities maps and role profiles, to ensure that firms have a running record of temporary allocations to unapproved individuals. Now, for solo regulated firms, the FCA actually announced yesterday that they have extended the maximum period firms can arrange cover for a senior manager without being approved from 12 weeks to 36 weeks in a consecutive 12-month period. Firms can use this, what they're calling modification by consent, if, for example, a senior manager is absent because of coronavirus, or recruitment to replace a senior manager has been delayed due to the pandemic. Firms can apply for the modification by consent as a precautionary measure in advance of actually needing it. The modification by consent will take effect from the date the firm applies for it and will end on the 30th of April 2021. There is an expectation that firms clearly document these responsibilities, however temporary, including on relevant statements of responsibilities and responsibilities maps, if applicable. Usually, prescribed responsibilities can only be allocated to another approved senior manager under this rule. All firms, dual regulated and solo regulated, are expected to still do this if possible. Under the modifications, firms will also be able to allocate the prescribed responsibilities of the absent senior manager to an individual who is standing in for the senior manager, even if they're not approved. Our view is that all firms should consider the temporary arrangements that may need to be implemented in light of COVID-19 and ensure that all documentation is updated to reflect this as soon as possible. Firms should update the PRA and/or FCA supervisors by telephone or email in relation to these temporary allocations. In particular, for individuals who are not typically classified as senior managers under SMCR and do not require regulatory approval, however have taken on temporary arrangements, we would recommend that these individuals have undertaken adequate training in respect of the senior management conduct rules, the definition of reasonable steps, and examples of potential conduct breaches as any senior manager would be expected. In addition, we would recommend the unapproved senior manager to liaise with the absent senior manager if possible to ensure an adequate handover and to include HR and compliance in that consultation. It is possible that some firms may have to make the tough decision to furlough senior management during this time. The PRA and FCA appreciate this may be the case, however, encourage all firms to carefully consider the risks and unintended consequences of furloughing non-mandatory SMS holders. Firms should update their supervisors of any furloughing of one or more SMS by email or telephone. For dual regulated firms, the PRA and FCA's latest statements provide prescriptive guidance on combinations of SMS that dual regulated firms must perform at all times, irrespective of the potential impact of the coronavirus. Essentially, this means that dual regulated firms must have individuals performing one of the following combination of SMS at all times as a minimum. So the CEO, which is SMF1, CFO, SMF2, and chair of the governing body, SMF9, head of overseas branch, SMF19, where that's applicable, probably more likely to be relevant to banks. The small insurer senior management function, SMF25, the small non-solvency 2 insurers, and head of small run-off firms, SMF26, the small run-off insurance firms. The regulator has explicitly stated that individuals performing SMF16, compliance oversight, SMF17, the MLRO, and limited scope function, SMF29, should only be furloughed as a measure of absolute last resort. As mentioned before, firms can use the 12-week rule or 36-week rule to arrange cover for individuals performing one of the mandatory or required SMS should they become absent. Other SMS are not mandatory under PRA and FCA rules, so firms have greater flexibility than was previously available to them. However, the regulator has stressed that firms should think carefully about the risks and unintended consequences of furloughing non-mandatory SMS, and in particular, those responsible for business continuity, cybersecurity, or outsourcing. So, for example, SMF24, Chief of Operations. For solo regulated firms, by contrast, the FCA has not prescribed any specific requirements for mandatory SMS, with the exception of individuals which may be considered key workers, such as SMF1, the Chief Executive. Unless a furloughed SMF is permanently leaving the post, the individual will retain their regulatory approval during their absence and will not need to be reapproved unless they are permanently leaving their role, in which case, of course, a Form C would need to be submitted. However, it is important that firms ensure that furloughed SMFs remain fit and proper on their return. If a firm is subject to the overall responsibility rule in SIS 26, the responsibilities of the furloughed senior manager must be allocated to another senior manager. If the firm is relying on the 12-week rule, the replacement does not need to be a senior manager. So just moving on to demonstrating and evidencing reasonable steps. Many firms have questioned the impact that coronavirus has on accountability for decision making and how individuals can demonstrate and evidence that they are taking reasonable steps during this uncertain time, which is absolutely a fair question. However, from the regulator's perspective, the underlying principle of individual accountability for decision making has not changed. The onus is on the firm to adapt to the different environment we live in now under the SMCR, and naturally senior managers are very much part of that. Both the PRA and FCA have stressed the importance of continued strong governance through this crisis. SMF holders are going to have to make a number of tough and key decisions in the coming months, in some cases sooner than they might usually do. It's important that SMF holders clearly and comprehensively document rationale for decisions and actions taken. Given the shock that this crisis has presented to the financial markets and the potential long-term implications, it's never been more important to maintain clear and complete audit trail for all key decisions that are made. Ultimately, firms' records need to be kept in a way that is readily available and presentable to the regulators on demand. Many boards and management teams will not be meeting during this time, or alternatively will be meeting via video conference. There is a challenge in that meeting minutes may not necessarily reflect the robust challenge that's happening, and the input that each individual is having into collective decision making, and therefore it's important that each SMF holder takes personal accountability for the responsibilities that they are discharging. Given the fast-moving nature of the crisis, regular virtual meetings of senior management could be scheduled to identify new developments, understand regulatory expectations, and the impact of policy decisions on the firm's business, and to set the firm's overall strategy on responding. Records should be kept of key decisions taken at meetings to demonstrate how the management team has responded and what key issues have been considered. We also suggest maintaining a personal record of CPD and trading webinars such as this that you might have attended. One area which has definitely become more challenging in this environment for senior managers is maintaining oversight of employees and the systems that they are using. Consequently, there is a heightened risk of market misconduct and cybersecurity breaches. Reasonable steps in this context may mean implementing changes to monitoring systems, communication from management teams about managing contact risks, and ensuring these are managed within the organisation's risk appetite. Appropriately adapting and updating existing management information and information flows is also likely to be important. In addition to these specific considerations under the SMCR, boards and SMF holders should carefully consider the impact of COVID-19 on its customers and products and implement measures accordingly. Consideration should also be given to whether the current control environment is appropriate and within risk appetite. Of course, the well-being of the firm's employees is also paramount. As a starting point, firms would have considered, I'm sure, health and safety risks. However, the general well-being of staff can often be overlooked. Regular check-ins with all employees by team leaders using video conference where possible, the provision of counselling advice, and working groups for absences due to childcare or care commitments are also highly encouraged. It's important firms continue to maintain a focus on culture. SMF holders should keep in mind that many employers will find themselves under significant pressure in the coming days and weeks, balancing their workload in an abnormal and unprecedented way for extended periods of time. Regular reminders of the firm's values and standards of professional behaviour can be key in motivating and energising individuals. Example setting from senior managers will be more important than ever. I also wanted to cover what we are seeing and hearing in terms of the practicalities of operating effective in corporate governance. In times like this, the need for clear and decisive leadership based on reliable information is more crucial than ever. Meanwhile, disruption to working practices makes this harder than ever. The buck stops with the board. We all know that an effective board defines the company's purpose and then sets the strategy to deliver it. This purpose is absolutely still relevant, as I mentioned earlier. Based on our conversations with SMF clients and through what we know the FCA and PRA are asking of firms, we thought it might be helpful to set out some of the key questions SMF should be able to both answer and evidence. What work has been done to consider how consumers have been impacted by the COVID-19 outbreak in the context of your business? How has COVID-19 impacted the products which you offer to consumers? What additional measures have you or the firm put in place to support affected consumers, including the vulnerable? How did you make these decisions? What work has been undertaken to assess the impact of COVID-19 on your firm's finances and capital position? What succession planning is in place to cover any key absences, especially for SMS? What communication plans have you put in place, and how are you ensuring that these are clear? Are you comfortable that the control framework in place is within tolerance? How are you monitoring these changes? What work have you done to assess the ongoing financial and operational resilience of any third-party providers that you have? And are there any regulatory requirements that are difficult to comply with given the current environment? How has this been discussed at board level, and what decisions have been taken? In times of crisis, the quality of the relationship between the board and executive management is critical. This is not a time for confusion as to who does what. Whilst methodologies and processes may need to change as a consequence of COVID-19, the outcomes that the regulators expect have not. So I now want to move on to operational resilience more specifically. Clearly, this topic interplays heavily with what I've already covered when talking about governance. In particular, the expectation that how a firm is managing operational resilience should very much be a focus of the board. So, what have the regulators said about operational resilience, and what are their expectations? As you would expect, both the PRA and FCA have significant resources focused on their response, both for the firms they regulate and their staff. Dedicated teams have been set up, and the situation is being overseen by respective executive committees. They are in regular contact with firms to assess their current position and expect firms to be taking reasonable steps to ensure they are prepared to meet the challenges coronavirus could pose to customers and staff, particularly through their business continuity plans. There is a clear expectation for firms to provide strong support and service to customers during this period. They should be clear and transparent and provide support as consumers and small businesses face challenges at this time. Naturally, there is also a continued requirement for firms to manage their financial resilience and actively manage their liquidity. Firms should be escalating immediately if they believe they will be in difficulty. All firms should have in place contingency plans to deal with major events, and these plans should have been tested. Both the FCA and PRA are actively reviewing the contingency plans of a wide range of firms. This includes firms' assessments of operational risks, the ability of firms to continue to operate effectively, and the steps firms have taken to serve and support their customers. Firms should take all reasonable steps to meet the regulatory obligations which are in place to protect their consumers and maintain market integrity. For example, if a firm has had to close a call centre, requiring staff to work from other locations, including their homes, the firm should establish appropriate systems and controls to ensure it maintains appropriate records, including call recordings if required. CP 1932 already sets out both the PRA's and FCA's proposals for operational resilience, and therefore gives us a clear reference point for regulatory expectations in this area. Whilst these proposed rules are not yet in place, it is reasonable to assume that the themes covered should all be front of mind as firms deal with this crisis. Just as a recap, these key proposals for firms include identifying their important business services that, if disrupted, could cause harm to their consumers, retail and wholesale, or market integrity, setting impact tolerances for each important business service, i.e. thresholds for maximum tolerable disruption to help achieve consumer protection and market integrity, identifying and documenting the people, processes, technology, facilities, and information that support these important business services, testing their ability to remain within these impact tolerances through a range of severe but plausible disruption scenarios, and conducting lessons learned exercises to identify, prioritise, and invest in a firm's ability to respond and recover from disruptions as effectively as possible. Developing internal and external communication plans for when important business services are disrupted is also crucially important. Indeed, you may have already received contact from the FCA and/or PRA. We know that firms are being asked for information on a range of topics which focus on how they are responding to the crisis. These have included describing how firms have been impacted by COVID-19, requesting information on additional measures that the firm has put in place to support effective consumers, and asking for evidence of communications that a firm has or is planning to put in place. As I mentioned earlier on, it's been a busy 6 weeks or so for us, and through both the advisory work that we do, as well as the third line internal support that we provide to firms, we've been supporting clients through this difficult time. This has included helping them to ensure that they are operationally resilient and, importantly, can clearly evidence to the regulator that they are taking appropriate steps and where decisions made that these are reasonable. I thought it'd be useful just to set out some of the good practice that we're seeing. We're seeing a number of organisations assemble cross-functional COVID-19 crisis response teams and working groups led by a member of the executive management team. These response teams are typically defining key responsibilities, meeting frequencies, and management information requirements, and in turn provide regular updates to the executive committee and board. Further to BCP plans kicking in, time is also being taken to consider the current state. For example, undertaking detailed analysis of how consumers, clients, and more broadly, business services have been and will be impacted by COVID-19. Identification of immediate current strains and pinch points with resources supporting the delivery of key business services, i.e. people, third parties, or key systems and infrastructure, has also been a key focus. Identification and communication with critical suppliers to understand their current status with respect to the provision of outsourced activities and whether this is likely to be impacted is also something that we're seeing firms do. Firms are spending time to carry out additional scenario analysis and are identifying a range of severe but plausible scenarios that could occur in the short, medium, and longer term in relation to COVID-19. The impact of these scenarios are being considered in the context of the resources which support the delivery of key business services, third parties, systems, and staff, and the potential impact on clients, consumers, and financial stability of the organisation. In turn, firms are developing response plans should these scenarios materialise to reduce the level of impact in the context of disruption to key business services. Where firms already have in place established impact tolerances for operational resilience, we're seeing these revisited and revised. For firms that didn't already have them established, we're seeing key indicators developed and implemented. The final area of firms' focus relates to communication. Most of the firms we're working with realise that ongoing and accurate communication is key given the ever-changing nature of the current situation. Firms are typically defining clear guidelines and frequency requirements for ongoing communications with staff and customers and clients. Firms that form part of a wider group, all plans need to be coordinated to ensure consistency across the various entities. Time is also being taken to ensure that there is a plan of action for communication with the regulators, and it is likely that this will be requested. The communication should consider what the organisation is doing to minimise the disruption to its operations, details of the crisis response plan, overview of testing performed, including proposed responses, and plan communication arrangements with staff, customers, and clients. So that's it from me for now. I'm now going to hand over to Charles, who will talk more specifically a bit about the impact of COVID-19 on the insurance sector.
Thank you. Thank you, Richard, and good morning to you all. My name is Charles Portsmouth, and I'm a director in BDO's Governance, Risk and Advisory Services Group, and I'm also an NED at an insurance company board, so I bring some commercial perspective to this as well. I'm now going to give you, first of all, some thoughts around the potential business impacts we're seeing on underwriting and claims. Secondly, the potential effects or risks to insurance balance sheets and how CROs might be reacting to them. And lastly, some thoughts on the focus of the regulators, both now and ongoing. Firstly, many are identifying COVID-19 as potentially the largest insurance loss ever. The cost is sure to be multiples of prior catastrophes such as Hurricane Katrina, the 2014 Boxing Day tsunami, the Japanese earthquake and subsequent tsunami in 2011, or even the 9/11 attacks. That could be tens of billions or more, depending on how long the pandemic lasts and other variables. Insured losses in the US and UK alone could be anywhere from £8.8 billion to £112 billion, according to Willis Towers Watson. Insurers that have reported their first quarter results, which includes Chubb, Travelers, The Hartford, Markel, Swiss Re, have drawn a mixed picture of the damage so far, but all have predicted things will probably get worse. Markel announced a loss of about 1.4 billion, Swiss Re a loss of 225 million, but this morning Munich Re was still in profit despite large claims losses being taken. The key lines of business hit seem to include life and health, for obvious reasons, business interruption, policy and coverage issues have been well publicised, but Hiscox, RSA, and others, and the FCA are already intervening in the dispute by seeking an early judicial hearing on the disputed wording issues. Travel insurance, for obvious reasons. Credit insurance. Claims will inevitably arise, and underwriters have probably put away their pens for the moment, given the current economic uncertainty. Cyber risk insurance, as the fraudsters come out to play, with the increase on home working, straining networks, and cyber security, etc. And lastly, the contingency market. For instance, Swiss Re and Markel faced big hits from the cancellation of major global events like the Olympics and Wimbledon, who had the foresight to take out pandemic insurance coverages. There are many other events already cancelled, and possibly many more to come as the effects of coming out of lockdowns are gradually realised. There are other areas of risk which will surface, though, as time passes. For instance, marine hull underwriters are now becoming concerned at the number of cruise ships sitting in Miami Harbour and or other parts of the Caribbean just as the hurricane season starts. An unexpected concentration of risk and exposure, similar to the one suffered by the marine cargo market during the Thailand floods a few years ago. Further insights on the business impacts will arise as other major insurers report the results through the rest of May. And this includes Lloyd's, who are expected to release an update on COVID-19 claims exposures in the next few days. However, insurers generally expect the pandemic to remain an earnings issue rather than it becoming a question of viability. But they have warned that problems are sure to crop up in businesses that have not yet experienced elevated claims or lawsuits. The viability issues will be in other sectors of the economy, I suspect. Some areas of underwriting will, however, improve. For instance, motor will have lower loss rates because of the lockdown, and insurers are already volunteering returns of premium. Certainly, our car insurer has already done so. There will be further effects, though. Demand will change for some insurances. Credit risk exposures will undoubtedly continue to increase, particularly in the retail and leisure sectors. And a consequential rise in potential premiums may mean underwriters finding their pens again and business being written on the back of hardening rates. Rates may well harden across the board, and we are already seeing the potential for that with Hiscox, QBE, and R&Q announcing capital raises to enable them to pursue potential underwriting opportunities in the future. And we've seen this happen before as part of the response to past extreme loss events, such as 9/11 and Hurricane Katrina. Other commentators note that the private equity sector may be busy exploring opportunities for itself. As always, where there is risk, there are opportunities. However, we should all remember the old underwriting adage: good years get better, bad years get worse, and I suspect 2020 will be classified as a bad year overall. My apologies, I forgot to move on the slides. Turning to the potential balance sheets impacts for insurers and think about how they should be responding. This week, AIG reported lower than expected operating earnings of $99 million in the first quarter, a huge drop from the $1.4 billion reported in the same period a year ago. And that result was driven by a steep decline in income from investments and $272 million of estimated COVID-19 losses related to travel, contingency, commercial property, trade credit, and workers' compensation. The potential impacts for insurers can perhaps be summarized as equity market impacts on insurance investment portfolios. This is not only applying to insurers' balance sheets, but will be affecting pension funds and many other businesses. Indeed, Middlesex County RFU, with which I am involved, suffered a valuation loss on its portfolio of some 30% during March. And while this has bounced back subsequently, we're still some 20% down on the end of January valuation. Investment income will also be down as dividends are cancelled or deferred in the current crisis. The low interest rates continue and are unlikely to improve in the short term, at least I suspect. And meanwhile, there is a distinct possibility of both recession and an increase in inflation. Although it is currently lower because of the effect of COVID-19 on oil prices. I'm not an economist or an investment manager, but this may well have an effect on bond prices as we go forward. Indeed, the Monetary Policy Committee noted this morning a fall in economic activity of 45% and consumer demand is down by 30% over the last couple of months. In terms of credit exposure, there will be a deterioration in ratings, which may not filter through into the ratings of the credit agencies, who I understand are taking a longer-term view. However, many sectors will have viability issues, which will impact customers in terms of bad debts, on premiums, exposure to financial institutions, including reinsurers, who may well be affected, and this might have an effect on credit ratings, which may need to feed through into capital calculations for those insurers. There will be FX implications for asset and liability matching as claims flow through in different currencies, putting a strain on balance sheets, and inevitably there will be changes to liquidity needs, particularly if there is a regulatory and customer pressure to settle claims quickly to help businesses survive in the wider economy. The FCA's determination to get a quick judicial opinion on business interruption policies and their disputed wording, an example of this already happening. So what does the board and in particular the CRO and the risk management team need to be doing to both inform and challenge their business on its changing risk profile? Because that risk profile has undoubtedly been changed by recent events. From a personal perspective, the CRO needs to be taking reasonable steps as a senior manager, as Richard has already mentioned. But what might these reasonable steps be expected for him? First of all, challenging the first line of defence in terms of its COVID-19 crisis response management was the initial probably part of his response. The next phase of this might be, and this is possibly in conjunction with internal audit as the third line of defence, to carry out a lessons learned review over crisis management, operational resilience, and other matters such as staff performance and well-being, etc., in order to improve the company's risk management going forward. As Richard mentioned, scenario analysis is going to be key, and he and his team need to be considering their realistic disaster scenarios in the light of COVID-19. 6 months ago, pandemic was a green dot on many or even all companies' emerging risk reports. It is now crystallized, and as a result, real risk is being recorded into risk registers and has possibly been through or is still at the red stage in those registers, although it might be lowering in the near future. However, I bet the current scenarios did not effectively map the crisis and its possible impacts. How many scenarios considered a complete lockdown of much economic and all social activity for the potential length of time we're seeing at the moment? So this means reviewing the predicted effects and ensuring they're updated to real-life reality, both in the short and the medium to long term. The latter might be difficult to predict as yet, so a range of scenarios might be needed with differing assumptions. Turning to the ORSA will need to be reviewed and possibly, dare I suggest it, rerun, both from an internal but also an external perspective. It will need to consider that awful piece of jargon we're now hearing on a daily basis, the new normal. Regulators, once the initial crisis is over, may be expecting a rerun as part of the proper functioning of risk management frameworks. So dusting off that ORSA policy is probably a good idea, because proactivity rather than reaction might be the order of the day here. This will mean revising 3-year business plans, reviewing capital management plans, and if necessary, reporting the results to the regulator as required by the SMCR and the related conduct rules. A regulatory communications plan also needs to be put together, perhaps. So where are we seeing the regulators focus, and where might they focus next? Richard has already covered the details of the SMCR regime and some of the detail of where we're doing it, of seeing it elsewhere. To start with, the PRA and FCA were both focused on business continuity and operational resilience. They will continue to do so, but there have been no horror stories surfacing as yet about insurers and indeed any other financial institutions failing in this respect. The telephone queues are inevitably longer, but there seems to have been little else to report. This is remarkable and is a great achievement for all elements of the financial services sector and indeed businesses like ourselves who have almost overnight become used to home working and yet getting on with day-to-day business and attempting to make it business as usual. Yesterday, I personally chaired an insurer's virtual audit committee and attended a virtual risk committee over Zoom. I would not have predicted that occurring when we last met in face-to-face committee meetings in February. As you might expect, the risk committee had some interesting discussion during it. So operational resilience appears to be improving. And of course, the regulators have assisted by softening the deadlines for regulatory submissions and also slowing down their regulatory change agendas. Indeed, there were further announcements on this for banks this morning. The PRA are unsurprisingly focused on financial viability and the ability to pay claims to policyholders. They have already requested statements from insurers on potential exposure to business interruption, coverage, etc. As other classes become a potential issue, no doubt they might request more data like this. The PRA will now be receiving year-end reporting, including COVID-19 exposure assessments in the SFCRs and the reports and accounts. Therefore, they will be better able to focus their attention on those that might be at greatest risk from a viability perspective. The FCA will be and have been highlighting the conduct agenda, treating customers fairly, both in terms of claims handling and policy terms and conditions. We have seen speedy statements, as Richard mentioned, setting out their expectations on this, in particular classes, such as motor insurance, home property insurance, etc. And of course, their intervention in the business interruption market I previously mentioned. I suspect as time unfolds, we might see more regulatory interventions like this from the FCA as they seek to ensure their objectives are met, particularly for those seen as financially weak, retail and SME business customers. And finally, I want to end by noting that this is the first real crisis that the regulators have faced as separate and distinct units. The 2008-09 financial crisis was overseen by the FCA, and the failings identified in its response led to the impact or the advent of so-called Twin Peaks regulation and the splitting of the FCA into the PRA and the FCA with their two distinct and differing regulatory objectives in April 2013. 7 years later, they're facing an enormous test of their skills and competency and indeed of how they work together. I wonder how we and history will come to judge their efforts. Thank you for listening, and I'm now going to hand back to Richard.
Thanks, Charles. Well, we've got a few questions that have come in. The first one that I'll tackle is just a question around what we're seeing firms do in relation to conduct risks. So I think perhaps the best way to answer that is to first mention what we've seen the regulators doing. And I suppose the FCA in particular, as you would expect, has issued a number of statements and Dear CEO letters in recent weeks, which clearly set out their expectations on how firms should carry out their business in the short term. And it is a certainty, I think, that firms who do not have conduct risk and customer outcomes as a high priority will almost certainly face significant scrutiny later in the year. And I think if you follow that thread, then firms should certainly be investing time now to ensure that potential conduct risks directly related to COVID-19 are quickly identified and mitigated to minimise failures and avoid costly remediation exercises later down the line. I mean, just to add a bit more colour to that, one way we're seeing firms do this is by bringing their first and second line teams closer together so that they're more fleet of foot in identifying potential issues in this rapidly changing environment, and also establishing what firms are sometimes referring to as exception channels to cater for sort of atypical sales or changes in procedures or processes or servicing of operations, and they're finding that quite effective in dealing with instances of potential conduct risk. We're also seeing temporary design authority groups established whose sole purpose is to review potential customer harms which are resulting from changes to existing processes and operations which have been brought about by COVID-19. And then just sort of putting my sort of governance hat on, there's a few things that spring to mind that boards and SMS, I suppose, are considering relating to this conduct sort of agenda. So certainly, how have consumers and/or products been impacted in the context of the business? Have any consumers that perhaps weren't previously vulnerable become vulnerable? And has there been enough work carried out to actually identify and clearly articulate how customers have been impacted? And then finally, I suppose, what additional measures have firms actually put in place to support affected consumers? And obviously the one thing there that the FCA is always very focused on is vulnerable consumers. So I think that probably covers that one. Another one I've seen is, what's our view on how PRA and FCA are coping with potential impacts on their turnaround time? So yeah, that's a good question. I think certainly for the first 2 or 3 weeks, things did go quite quiet over there, both at the FCA and PRA. I think, like all of us, as they adjusted and implemented their BC plans to get people working from home. I think in terms of turnaround times on things like approvals and applications, things like that, certainly those that are going through sort of the more kind of centralised call centre type approach or contact centre approach, there are delays happening there. And I think all you can do is if you're waiting for a response or something like that, just sort of keep asking them for the answer. I think what we have seen in the last couple of weeks, more broadly, certainly if I think about some of the Section 166 work that we do, and also some of the other kind of non-Section 166 but regulatory-driven reviews, if you like, that we do, a lot of those have come back online now. So I think whilst there might have been 2 or 3 weeks, where, as I say, both the regulators were sort of collecting their thoughts, there is a bit of a message, I think, that we need to plough on where we can on reviews. And I think in the large, a lot of the work we are able to continue on. So that's that one, which I hope is helpful. I mean, Shrenik, I think there's a couple of questions that you might be well placed to answer. I don't know if you can tackle those.
Happy to, Richard. So there was a series of questions, I think, particularly in relation to SMCR and the more recent statement that was the joint statement that was issued by the PRA and FCA on SMCR. So one of those questions was, wouldn't the regulatory focus fall to the individual with prescribed responsibility for correct implementation of the regime? So those are specifically prescribed responsibilities A and B. And our answer to that is really yes and no. The individual which is allocated the prescribed responsibility for correct implementation of the regime, which is quite often the CEO, may receive a heightened focus. However, it's important to reiterate the point, I think, that the PRA and FCA have categorically stated that a single senior manager should not be solely responsible for the firm's coronavirus response. I think the onus is on all SMF holders and individuals which have been allocated prescribed responsibilities to ensure those responsibilities are fulfilled to the extent that they can be during this time. Another question that we got was around non-SMF holders that have prescribed responsibilities allocated to them in the absence of the SMF, and whether or not they will have the same statutory personal accountability, which I think is a very good and an interesting question. And it's not clear at this stage what personal recourse there will be to non-senior management function holders. And there is, of course, a potential risk that individuals who do not carry out their new roles to the expected standards, will face some scrutiny. But we anticipate that other SMFs will support these individuals to help them ensure that they're able to demonstrate reasonable steps and they're able to fulfill their regulatory responsibilities. And that would include having access to the right governance forums and also the right level of management information. The final point the question I'll cover in relation to SMCR before I hand back to Richard is around furloughing of senior management function holders. So the question was, furloughing a senior manager who retains a senior management function does not make sense because a furloughed employee cannot work for the firm in any capacity. Therefore, how can they continue to be responsible for senior management functions when they're out of the loop completely. And our response to that is just to clarify, the furloughed senior manager will not retain their accountability and responsibility for the senior management function. That will shift to the senior management function holder that has temporarily taken over responsibility for that function. And the furloughed staff will maintain their regulatory approval unless they are permanently leaving their role. So on that note, I'll hand back to Richard, who can close the webinar.
Yeah, I mean, we perhaps have, there's been quite a lot of questions, but perhaps time for one more. I mean, Charles, I don't know if you're still on the line, but there's a question around how hard the contingency book in the market is being hit during the pandemic. I mean, I don't know during your, through some of your broader experience that you have as being a NED and stuff, if you've got any insight to provide on that.
Anecdotal, I think, is the answer to that, and there will be different answers to different parts of the book. So let's take Wimbledon for an example, where the event has been cancelled this year, and there's a one-off overall loss of income to Wimbledon, and it was lucky enough to have the coverages in place. That's a hit to the contingency book. In terms of the Olympics, it's been shifted by a year. There will be some costs relating to that, but I suspect the hit will be less because it's been moved by the year. And there are lots of businesses who haven't got pandemic coverage. So let's take the Rugby Football Union, for instance. They've missed a bit of the Six Nations. They don't understand what is going to happen with the November internationals. They're talking about a £50 million hit to their top line in terms of funding being received. And they certainly don't seem to have pandemic coverage, which will take you on that. So it's difficult to say how hard the contingency book is going to be hit. And we've only got anecdotal evidence to work with at the moment. I hope that answers the question to some extent.
That's helpful. Okay, well, I think that's probably all we have time for today. So I think just to say thanks everyone for attending. Hope that you found it useful. Obviously, as I mentioned at the start, we'll send around a link to the recording and also the slides after this. And if you do have any feedback, then let us know. That would be great to hear. And please do all keep well and keep in touch. Thanks very much.